My name is Simon Ibbitson. Thank you very much for the CV. I am currently the head of sales and distribution for the Julius Baer private markets team. I've had 21 years in the private markets business and 15 years in the public markets business as a trader with SG Warburg, UBS. Some of you may remember SG Warburg. I meet a lot of people these days who've never heard of it. And for 3 years prior to that, I was in the Fleisch industry, mit mein Vater, in the UK. When I started 21 years ago in this industry, there was far more publicly owned companies than private equity owned companies, because the industry was fairly nascent. Nobody really wanted to know about it. It was a very difficult promotion to make. But what's happened in that 21 years, slowly, there have been fewer and fewer public companies listed and more private equity-backed companies in existence. And I think it's been a push and pull. Markets have been, or companies have been pushed away from the public space because of onerous regulations, etc. It costs and all sorts of tasks to fulfill, and they've been pulled to the private space because there's been more capital around. There's more capital around because it's been successful in the main with the more successful managers. And also an entrepreneur, business people can run their businesses privately for longer, and I think that actually plays out to a better strategy. So what has happened is that there's been a skew to these gargantuan companies of $1 trillion plus that 10, 20 years ago we couldn't have imagined. I remember the days when ExxonMobil was the largest company on the planet, and that had a market cap of about 350 billion. So there's been there is a concentration now, especially in indices. And this has actually played into our hands in the private markets because there are many thousands and thousands of companies out there in the world that are doing very good business and very innovative things. In our world, there is the widest dispersion between the good and the bad guys. And the reason for that is because sometimes a private equity manager is the sole owner of a business. And so if that business fails or succeeds, that's going to have a big impact against your peers. And when you look at the credit markets, of course, returns are clustered because there's only so many bonds to buy, and then it's just a question of who owns what, when, and for how much. And so what I've always thought is that actually where people perhaps need advice or their hands held to get access to valuable investment opportunities, which is what the title of this little piece is about, that actually it's the private markets that is the most difficult to access. Yet, in my experience with a lot of clients, that people tend to say, no, I'll do that myself, thank you. Which I think actually intuitively is the wrong way around. That might be a contentious thing to say, but we know what bonds are available. We can identify equities on the market, but actually trying to get into really valuable investment opportunities, I think it really pays to work with people who do that for a living, because it is a difficult environment in which to access. And how do we access that environment to find these valuable investment opportunities? Well, we have 5 business lines. Now, the rules of the game dictate that I don't talk about specific products. I shall not do that. I will just allude to what we do, but our first business line, we have an annual multi-manager program where we select 7 to 10 managers and populate it with some co-investments, which gives a great diversification. We have a feeder business, and as the introduction said, I was one of the founder members of the UBS team. Some of you may remember the old UBS products of Alps and Stripes. It was me and my 4 mates who brought that in many years ago in 2001. We do feeder funds, so that's what banks do. We create feeder funds, reduce ticket sizes. We are stringent with our deal selection. We have an impact business now that we started up because there is more focus on that particular aspect of investing and of life, really. It's the same principle as the feeder fund. And we offer reduced tickets at 250. Now, we're not JP Morgan or Goldman's. We don't have a big capital markets business, but we do try and offer co-investments. And I think it's very important for clients to offer a full suite So the way we source our co-investments are through the general partners with whom we work, in either the vintage program or the feeders. And so if they are leading the deal and they are investing their clients' assets in the deal, we will always have a look. But it's a sporadic business because there's a lot of competition today. Huge amounts of competition for deals. There's a bigger appetite from investors, and there are only so many deals to go around. And of course, what you don't want to do for a client is lose them any money. Howard Marks, the founder of Oaktree, says that it's not the making money that's important, it's the not losing it that is crucial. And we also have a burgeoning custom mandates business as well for those clients, family offices, etc., who want to commit more than 30 million. We work to a specific mandate. And of course, if anybody needs to get out, and people do need to sell things in life for various reasons, we have an internal auction secondary platform. I thought I would touch for 30 seconds on each slide about structures. For those of you who do business in Europe, you know it's not the easiest place to do business. I've grown up, when I started in 2000, the world was very different before Lehman, and then it changed after Lehman. We've got a myriad of rules and regulations. So what we decided last year, in order to appeal more to the European clientele, we brought in something called an ICAV. It's an Irish investment vehicle which has an AFIM, an alternative investment fund manager. This is a new imposition. It gives us certain rights. It confers us certain rights to just be able to speak to people and approach people. And it, of course, costs a bit more because it's a heavily regulated vehicle. So that is for the vintage program that we do. And then on the ordinary, on our impacts and our feeders and our co-investments, we just use a straightforward BVI structure. It's a bog standard limited partnership, ideal actually for Swiss book clients. And it's really very cheap to run, and they work. We made the cookie cutter years ago, and now about 6 or 7 times a year we just make a new cookie and put the funds in there. Sales support, of course, is very important. We do support that, quarterly reports, etc., etc. And that is the team that does our business. It's headed by a Swiss gentleman called Thomas Bischoff. He's been involved in the private world for 22 years here in Switzerland. I came in on the 1st of April last year, just at the start of COVID, so I really haven't met many of my colleagues face to face. We've been doing a lot of it over the television, which actually I've found really efficient. And we have a team of 4 people who are really the engine room and our eyes and ears in the market, looking at the investment opportunities. So I will stop there, and hopefully, if 1 or 2 of you have a question, I'd be delighted to take it. Thank you.
Questions? How do you see the market expanding from here?
The private markets. Look, I think I've always said in my 21-year career that it isn't a schwarz oder weiß choice between private and public. One should have both. And I think there's plenty of room for the private markets to grow. I don't see the regulatory environment changing for public markets. Of course, public markets will always be present. Of course they will. They will always be larger than the private markets. And they will always be one of the exit routes for private equity-owned businesses. But I see our market developing. Every year I've heard since 2000 that there's too much money being raised in the private markets, and every year I've said, well, I don't agree with that statement. And there's nothing that has changed my mind to say that we're going to stall. You know? And I think one of the interesting things about our business, when people talk of private equity, they either think of limited LBOs or they think of venture capital. But it's a whole mix. There's all sorts of things. And private capital is usually at the scene first of a financial disaster because they can go in and fix and repair things. There's always innovation. That will never stop. There will always be bright people looking for capital. That will usually come from the private markets. And there'll be entrepreneurs who don't want the glare of public markets and in fact don't need now to cash out to go to a public market for an exit route because you can sell privately too. So I think it's going to continue, and also as accessibility, and I think I'd sum up the first part of the 21st century with one word of accessibility. Our business is far more accessible now to clients, large and small, be it through banks like us or digital platforms or broking shops that have deal flow from time to time. So I see it expanding.
Thank you.
Thank you. Sir? The what, sorry, sir?
The machine room you mentioned, your 4 colleagues, how do they, identify and select all these opportunities?
Thank you. What I said earlier about private markets, people say, no, it's okay, I'll do it myself. It is it's a slightly opaque business still, the private world. You can't just Google up and find out who's done what where. One has to either subscribe to big databases or be in the business yourself or take advice. So we have my 4 colleagues in the investment selection team. That's all they do during the day is really speaking to fund managers. We get a lot of inbound calls from placement agents. We do a lot of reading, of course. But also, I think one thing, a really great attribute of our business when Thomas set it up 8 years ago was we work with a very responsible and due diligence partner that we actually term the Bloomberg of the private equity business. We pay good money for access to their database. There are 12,500 fund management groups on that database. And so we do see the world. We have to be cognizant as to who is raising when, because of course fund managers are not in the market all the time, like a mutual fund or possibly some hedge funds. So they come and go. So we have to be cognizant of timing. Also, what sort of strategies are applicable today, but not just today, but over the next 1 or 2 or 3 years. So it's an informed judgment that we make. Are we going to pick the best guys every time? No. But what I think we'll certainly not do is pick the worst guys. So as long as we're consistent, I think, in our selection, and we have been, thankfully, and I really do, and I would say it again, that I think it does pay in this business to take a little bit of advice. Also because, a mutual fund, you can invest $100 a month if you want, 100 Swiss, 100 sterling, pounds. If you're going to get involved in a private business, it's usually a $3, $5, or $10 million ticket, so you've got to be pretty confident. Also, the holding periods are protracted. If it's not doing well, it could be tough to get out. So there's a lot of mitigating factors, I think, that you have to take into consideration before you decide to make an investment in private equity. That's why banks exist, I think, private markets teams. So, but we spend an awful lot of time, because if the product isn't good, no matter how we dress it up, it's not going to be a good experience for anybody.
You mentioned that you avoid, obviously, you mentioned that you avoid to pick up the worst companies.
Yeah.
Have you made some mistakes, or what were the main failures, I would say? Yeah,
we can. My first ever fund, I'll tell a little story. The first time I ever raised a fund was in 2000. It was for a British business called Candover. I don't know if anybody remembers that name, but it was one of the top 5 buyout shops. It was a great business, and we raised it twice at UBS, and it was taken down after the financial crisis. It had a great record going back to the mid-'80s, and the point of that story is that one can only do so much. You can look at the ins and outs, meet the partners, understand their psyche, how they're working with each other, the staff turnover, their hit rates, their consistency, is their return skewed by 1 or 2 lucky punches. You can do all of that and come confident that you've done your homework and this should be a good investment. But of course, sometimes it doesn't work out. But I am proud to say, and I haven't been part of it for most of the time, I've only been at JB for a year and a half, we have no casualties. And we've raised over 50 funds. We've got one fund that's teetering on the verge of breaking even. But, a casualty in our industry is a business that loses, say, 10, 20%. And certainly no write-offs. And this is why funds, actually, the risk-reward, I think, for funds is compelling, because you are diversified. It's very seldom that you get a horror show in a fund. It can happen in VC, especially early stage, when you're giving birth to companies, because there's more risk. But if you're going up the maturity curve, if you like, It seldom happens. So, yeah, we don't pick right every time, but we haven't picked wrong so far, if you see what I'm saying. And I think that's really down to the homework. And you know, one of the reasons why I've stayed in this industry for 21 years, one of the reasons, is because I've represented managers on many occasions that have impairment ratios, loss ratios, in single digits as percentage. In fact, we just selected one manager for the vintage program. They've been going for 22 years. They haven't lost one deal. They haven't lost a cent for clients. Now, it's not many industries where you can say that. But there's a perception that our industry is a bit risky because it's illiquid. Well, I personally think that that's actually one of the best things about our industry. It is illiquid, and the manager is not having to reshape his portfolio with what the instructions that he receives from his investors. So we do our best, and we're doing okay, I think, really, for clients at the moment. Yeah, thanks.
Another question? No?
Okay.
Okay.
Well,
fine.
thank you very much. I appreciate the time. It's very nice to speak to you, and enjoy the rest of the afternoon. Thank you.
Thank you very much, Simon.